The fear of history repeating itself haunts the financial world, as a prominent CNBC anchor, Andrew Ross Sorkin, expresses his anxiety about an impending stock market crash, reminiscent of the 1929 disaster. But is this concern justified, or is it merely a case of historical déjà vu? Sorkin, a seasoned financial journalist, believes the current market conditions mirror the eve of the Great Depression. He argues that the inflated share prices, speculative bubbles, and weakened financial safeguards create an environment eerily similar to the past. But here's where it gets controversial. Is this a case of overreaction or a genuine cause for alarm? In an interview with CBS News' 60 Minutes, Sorkin, who has authored a book on the 1929 crash, draws parallels between the booming AI-driven market of today and the Roaring Twenties. He notes the astonishing 90% surge in the stock market from 1928 to September 1929, a period of excessive optimism that ended in a devastating crash. Sorkin's concern? The market might be on the brink of a similar meltdown. The recent performance of the stock market has been impressive, with the S&P 500 and Dow Jones Industrial Average boasting double-digit gains. However, Sorkin points out that this boom is fueled by technology and AI, attracting a rush of investor money that resembles a classic speculative bubble. He argues that while AI brings legitimate innovation, the frenzy of investment could lead to a painful burst. Sorkin's observation is that the current economy is propped up by the AI boom, with hundreds of billions of dollars being invested. But is it a gold rush or a sugar rush? Only time will tell. What's more, Sorkin sees unsettling similarities between today's market and the debt-driven speculation of the 1920s. Back then, ordinary Americans were lured into the market with easy credit and the promise of wealth for all. Today, modern investors are enticed by private markets, venture capital, and lightly regulated startups, where risk is masked as opportunity. The situation is not yet critical, but Sorkin warns of increasing speculation and debt in the market. He highlights the post-1929 protections, such as SEC disclosure rules and consumer protection agencies, which are now weakening. Sorkin argues that the push to democratize investing by opening private markets to small investors could have unintended consequences, as it did in the past. So, is the market headed for a 1929-style crash, or is this a cautious overreaction? The debate is open, and it's a topic that will undoubtedly spark differing opinions. What do you think? Is the market on the verge of a catastrophic meltdown, or is this just a temporary blip?